Good evening, everyone. Good evening. Can I do a sound check quickly? Can you tell me if you can hear me? I'm trying a different microphone. So I'm trying a different microphone. It should be really good because it should be a better quality microphone. They're all good, but this should be good. If you can hear me. Leon, so I'll know soon enough. There we go. Yes, thank you. York, thank you very much. Hi, Leon. Good to see you again. Godwin as well. Thank you very much. All of you. Wow, that's great. There's so many of you, but as I said, Leon, good to see you. I assume at some point Diana is going to come in as well. I am, for those of you who don't know me, welcome. Tonight's topic is cryptos. Where could the next breakout come from? There's a lot that I want to talk through because there's quite a bit of stuff going on, and I would love for this to be as interactive as possible. So if you've got any comments or opinions, go for it. Just put it into the questions box. I don't think I'll be offended by anything. But obviously the goal here, we're going to be having a look at the markets, and the goal here is to do a sort of professional technical analysis of the market and what are the opportunities there. So excellent, thank you very much. Yeah, I've got a different microphone today, which is called the lavalier, and it's attached to the, it's just attached to, I was going to attach it to my t-shirt, but it should be really good. And so there's a risk disclaimer. I need to give you a moment to digest that. For those of you, again, who don't know me, I'm a London-based trader. I'm a technical analyst. I spend 90% of my life kind of talking about what the charts are doing in terms from a trading perspective. My investing is just my own portfolio. So publicly, I don't really talk about investing as much as I do trading. I just manage my investing, my stocks. I own a bit of Tesla, I own Microsoft, Walmart. I've got a whole lot of everything, but I don't talk about that very much. I obviously have crypto as well. But those are investments, and I think we'll kick off. There's a lot to talk about. It's a very cool topic. I would like for you to get a much clearer understanding and therefore more confidence about what you want to do, where you should go from here if you don't know already, what your next steps are, what your options are, just in terms of, this is meant to be constructive, and I wanted, there should be measurable differences after this. So on the agenda, we've got to talk about identifying the key support and resistance levels in the crypto market, possible price moves in the coming days or weeks, building a watch list of promising promising crypto assets. I'm checking the names, just waiting for Diana to show up. Okay, so that's it. On top of that, I'm also doing fasting, which I don't know if any of you are doing it or have done it or do it. So I have to stop eating at 6 o'clock, and then I can't have anything with any kind of calories in it till like 10 o'clock in the morning. So this is a big glass of juice, of tea, of mint peppermint tea. Anyway, I've never done it before, but I've been doing it for about 2 weeks now. It's interesting. My sleep is different because I don't have a full tummy when I go to sleep anymore. So my body isn't digesting food as much. It's really, I'm doing it to lose weight, not for any other reason, not to try and be super just it. But it's interesting. I wake up a lot more. This is a strange thing. I wake up a lot easier instead of groggy. And I think that's because there's not so much food in my tummy. Honestly, lately I've been getting up with such ease. It's great. Strange dreams though, really weird dreams. So let's do a live market analysis. Let's go across to the platform. I have both platforms, and I hope you don't mind. I'll just do it on the NT5. I don't mind. I like both platforms, but most people are using the NT5. There we go. Great. So, okay. So let's, just before we dive into this, let's talk about the conceptual difference between trading and investing. It's important because it gets people into trouble. My background, my previous life, I was in the movie business. I was in the film business. I used to do visual effects and animation from just after Jurassic Park first came out until 2008. I owned a production company with my best friend. I wanted to get out. It was very competitive. I didn't have any real financial experience. I had project management experience, which came with risk management experience. My dogs are trying to get attention. This is Phoebe. She's growling because she's got a stick in her mouth and she thinks someone's going to take it from her. It's okay. It's fine. And they want attention now because, yeah, you're fine. And this is Cleo. And Cleo's the sweetest dog you've ever met in your entire life. And all she cares about is chasing squirrels and going for walks. Hey, and she looks like a puppy and she hasn't aged and she's like 3 years old. No, you got to go in your basket, in your bed, in your bed. So then I had no financial education. I had to start from scratch. So in 2008, I just started kind of just as much as I could, absorbing everything I could. Point being, I started learning how to trade technically. I learned there's more than just stocks. Cryptos weren't even really a thing back then. Cryptos really only became a thing in about the last 5 years, 6 years actually. Even though they've been around longer, they just weren't really anything there. And the reason I'm telling you this is because I can relate to traders still coming in and trying to understand kind of what to do. So investing is when you have spare cash. This is important. So when you have spare cash and you don't know what to do with it, you don't want to leave it in the bank or in a high interest account. You want to put it somewhere where you're going to get some growth. And obviously with all the media giving us, social media, all these millionaires and billionaires, it kind of seems like you really feel the pressure to do that. Traditionally, that was stocks and traditionally property. Property, if you did it right, property would get you rich a lot faster than stocks, but stocks would do it in the end. So those two are historically proven, really reliable and safe, and you kind of have to go out of your way to really lose money on them. You shouldn't. Most people should be fine if it's the point is you don't need the money. So you put the money away, you leave it, and you need it to go up in value. So your chart, if it's a chart, or your instrument, your asset, can only go up in value. This is really important because that means you don't invest in something that goes down in value. It sounds stupid, but currencies go up and down. So currencies are not a good form of investment. Property, stocks are, because stocks, for example, are meant to be the best companies get qualified to get listed. This is the theory. They're meant to be good companies. They're qualified to get listed. Then they get listed. They should continue to grow. Doesn't happen, obviously, with a lot of stocks, but most of them do. And so your money should increase in value. Property over time should also increase in value. But currencies can go up and down, so it's not really a good thing. Commodities can also go up and down. So in terms of safety versus highest probability of probably giving you growth, it's going to be those, and then it'll go out. So cryptos within that picture would qualify to me as higher risk, higher reward. You can still invest in them, but you need to know where they belong. You need to know, like, okay, that's definitely more risky. Why? Well, it's higher, it's new. Cryptos are in there. We think they have been around for 10, 15 years, but 100 years from now, we might look back, Bitcoin might be gone, all of them might be gone. They might have completely transformed the way that they are used in society even 20 years from now. So they're still in their they're still trying to figure out what they are. Banks around the world and the powers that be are still trying to figure out what they are. So here's a couple of quick things. Governments, banks are producing their own central bank digital currencies, CBDCs. They're going to do it to compete with the market. It's a growing market. People definitely want it. We're a global market as well. So we need online currencies so that we can do transactions that are a lot more efficient. It's a lot easier. So in many ways, existing fiat currencies, your existing pound, sterling, euros, blah, 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 they're called fiat currencies. They're paper currencies, used to be measured against gold. They're becoming more digital anyway. When a bank lends you money now, if you ask for a loan or something like that, they don't give you the cash anymore. They give you a digital number on your account and they just allocate a certain amount. So believe it or not, fiat money is becoming a hybrid kind of, no, go in your bed, I'm serious. So fiat currencies are slowly becoming digital, and this is not conspiracy theory stuff. This is stuff you can just go out and verify yourself. Cash machines are slowly starting to vanish. Cash in itself, and this is more, some countries cash is king, but generally speaking, this is the case. So what we need to remember with cryptos for a long time is that they're still figuring out where they're going to be. It's kind of like a gold rush back in the day. There was a South African gold rush, there was a California gold rush. You could go there, and obviously probably the first few people that got there probably had, most of they would thrive on it, and then people would follow. And then also remember that when you got there would be people who would sell you the equipment, sell you the tents, sell you the plots, and there would be scammers, there would be all kinds of things. And it's the same kind of ecosystem that we have at the moment. It doesn't inherently mean that there isn't something here. There is. It's just that I don't feel like there's enough common sense and enough information about it. So the whole point of tonight is to take is to keep in mind that investing is when you put money aside for a 6-month, 1 year, 2 year, 5 year period, and your goal is that it must go up in value. Therefore, you're not concerned if it goes up one day and down the next. You could almost just check it every 3 months. Because do you conceptually believe that cryptos are here to stay? And if you do you think Bitcoin is the one to go all in on, or do you think you should put a bit in Solana or Cardano or Ethereum? And obviously when you do that, you start to go, well, maybe one of them will die out, maybe this one will do really well. You don't really know. So you kind of gonna have to keep an eye on it and see what happens. So if you are sitting out thinking, it's very choppy and volatile, and I'm not sure about this, I guarantee you the people in the bigger institutions that are very slow to change, that are very traditional, that are very scared of this, they don't actually know the future either. They might start to get clues. They might, because they're high level, they'll be in touch with the kind of people that would build an exchange. So then they'll start to hear, okay, these guys are going to build an exchange, they're going to start, they're going to start running Binance through it, or cryptos or whatever. They might get in on those things. So then they start to be able to see which way the land is starting to unfold, slightly ahead of us. But there's enough people doing this that, generally speaking, if you're following someone who really knows what they're doing, they'll find out about that stuff too. They'll be tapped into it. So here's the thing. Conceptually, I think cryptos are here to stay. I also think that we've been going through a major global upheaval. Inflation is a natural. Please, guys, if you're new to this, the rest of you know me already. If you are new to this, you need to understand, for example, if we go through to look at the global markets, you need to understand that a correction, the market always has a impulse move, then a correction. Okay, so it's a move out, it's like a breathe out, breathe in, breathe out, breathe in. It's very, very normal. It's very normal. And when we look at it on a long enough time frame, this can feel like a very long time. Here we have 2 or 3 months. In the past, we've had a year. Sometimes we've had 2 years for kind of recessions or bear markets. Here we've actually been less than a year. Where we at here, if we just kind of clock it in. Actually, if you go from the top, it's only been from December. It's only been really this year. And we've had a bit of a move. Now, it's important because what I want you to understand here is that recessions and inflation are almost always in those corrections. So here we had recessions. We didn't have inflation per se, we had a recession. Here we had a potential recession. And if you go further back, so in other words, whenever we have a correction in the future, it's always going to come with stock prices going down. So companies start to cut costs, which means people lose jobs, and then and often there's inflation that comes with it, because the reason it gets so hot is because they've been keeping low interest rates. All of that stuff is, I want you to understand, it's all normal. It's just the winter for the summer, but we haven't had one in a very, very long time. COVID aside, we haven't had one since the 2007-2009 global financial crisis. And so this is new for everyone. They're like, holy cow, this never happened before. But I started learning how to do all this stuff around about 2008. So I still very much remember that. And so I just want to let you know this stuff will pass. Absolutely, the war, Russia-Ukraine war, which is not going well for Russia, which isn't. That's got to come to an end somehow. That was a big component because there's so many commodities coming out of Ukraine. Ukraine is like the jewel in the crown. It was very stable. Democracies, interestingly enough, democracies are better for economies. There are almost no, what would you call it, autocratic or dictatorships where their economies are strong. Almost none. They're almost all broke because all the money goes to the people at the top, and the people at the bottom are kind of like earning nothing. So generally, democracies tend to do incredibly well. And so Ukraine, which is democracy, was thriving. 40% of the world, sunflower oil, massive wheat producers, everything. Russia's kind of running dry because of all the oligarchs which are draining all the money out. And I have Russian friends, by the way. I have Ukrainian friends, Russian friends. So I'm aware of kind of, the sensitivity of it, but like, let's kind of call it what it is. And so the point I'm mentioning this is because once that war goes away, and once COVID is sort of in the rearview mirror, we should be recovering relatively quickly. So that's investing. So investing, you're thinking, do I think cryptos are worthwhile? Yes. Okay. Then by that logic, this is why this is so important that I talk about it, because I always worry that people are tuning in and going, how is this relevant? I'm going like, well, if you want to know how to make money in cryptos, you have to decide if you're investing or trading or doing both. Okay, so are you investing or trading or doing both? If you're investing, you can only buy. You have one choice, you can only buy. the cheaper it is. So you would start with the idea, do I think cryptos are worthwhile? Do I think they're going to be around? If your answer is yes, then the cheaper they are, the further they crash, the further they fall, the more reason there is to buy, because you want to accumulate them. So it doesn't feel like you're doing it at the right time because everything seems like it's burning down to the ground. But one of the things that you would have wished for when it was up at the top was, please, can these prices come back down and I can get it at a discount? Now's the time. So, and you're thinking long term. So you're going, well, even if it stays where it is now for the next 6 months of the next year, it doesn't matter, because as long as in 5-6 years, and I could just buy $50, $100 every month, because by the time it goes back up, I'll be fine. And in that situation, you start to go, well, is Bitcoin the only one I want to be in, or do I want to distribute? So you start to think about things slightly differently. And that's a very healthy approach for that. It's a really healthy approach. It's problematic if you put, your mortgage, your house, you remortgage it and put it into this, because then you're too financially exposed on something that is too new, where the risk is too high. And usually the motivation for that is there were so many people making money off it before, and they're not making money now. I don't know. I mean, some of you may not know why cryptos have been crashing lately, but a lot of that has to do with an individual billionaire that has lost like literally almost all his wealth. So this is XTB, but and it's a warning. It also means that the absolutely uber wealthy, I think for me, the biggest lesson out of this whole story, if just Google it, what's going on, is that even billionaires can lose their entire wealth, and he did it in a matter of days. So it can happen. So, which is amazing. I mean, it's a bit of a consolation prize, if you've lost 10 grand or 20 grand. If you're in it, you haven't, then you just wait. So you just need to know, like, how much would you put away? How long would you leave it for? I'm not a financial advisor here. Everyone's circumstances tonight are individual. So the other thing that I always talk about is that there's a correlation between cryptos. There's a correlation between cryptos. So I'm going to just bring them up side by side. And you can obviously, let's just see this one. So what do we got here? Let's get this. Let's minimize this. Let's bring up beep, beep, beep. I'll just bring up oil, and I'll just make this Bitcoin. And then I should be able to bring these two. So I didn't do that. So I didn't want gold. Dollar index, I don't want. Oil, I'm going to get rid of. There's the Dow. I'll get rid of that. There's the Dow. And I'll just get rid of those two. There we go. Will it put the two together? Okay, there we go. So, and we'll do this one here. And then we'll take tech stocks. So my question to you is, do you think that cryptos qualify more? Do you think they're more like they're technology based, right? So would they be more like a tech stock than they would be I call them a digital commodity. So to me, it's a digital commodity. Why? Well, because if you had, yes, mentors. I've been asked if I had a mentor. I'll answer that. So, I was talking about digital commodities. So imagine it was gold rush. You found a piece of gold nuggets, right? So you got it in your pocket. So obviously there's an open market price for what they're willing to pay for gold. So, now it's like $1,700, give or take today, something like that today. So you've got this thing that if you sell it now, you'll get $1,700 an ounce for that thing. If you wait 6 months and gold price goes down, you'll get less for that piece of weight. And if you hold on to it for a bit and gold price goes up, you could sell it and get more. So that kind of makes sense. Here's the tragedy, is that if you put in your pocket and there's a hole in your pocket and you lose it, it's gone. So, it's gone. Plus the fact that actually, yes, we use gold in technology now. We use it in our satellites, we use it in our mobile phones, we use it somewhere. But 1,000 years ago, it was used for jewelry, and that was pretty much it, like our teeth and a few other things. But it didn't really serve a real super important function other than as currency, and it had value because it was shiny and it wasn't that easy to find, and we gave it value. So just humans by nature went, oh, I like this thing, it's shiny, we'll agree it's valuable. And we all agreed and we gave it value. But actually, it's just a piece of metal. It doesn't really mean anything. So these are all very interesting, because when you go across to cryptos, a crypto is a digital commodity, which, by the way, with gold, you could go and mine it. So you could go to the riverbeds and take a sieve and you could shake it around, maybe get some pieces of gold. So you could mine it, obviously, or you could go buy it. It's exactly the same with cryptos. You can go mine cryptos and earn them that way. Yes, you can. You might not get a lot, but you can. You can buy them. So it's exactly the same thing. If you store them on an external drive, for example, it's worth ultimately what, and you decide to sell it or buy it or to sell it, it's worth what the going price is in the market that day or whenever it is you decide to sell it. And if you lose this, you've lost it. So it's a digital commodity and it has value because we give it value. So I think in principle we can agree our money is becoming largely digital. Cryptocurrencies in some ways will merge with normal fiat currencies in their own way. Right now they're cousins of each other. And this is the new prettier looking cousin, but at some point they'll largely kind of merge. But that could be 50 years from now. But you can lose it. So I call it a digital commodity. But here's what I wanted to say. It's tech, it's technology. So when you go and you have a look at the tech stock chart, you can see that tech stocks have had the biggest correction of the global indices compared to NASDAQ and the Dow. So very quick, I don't mean to bore anyone. I'm trying to give everyone a brain dump of information here. The Dow was opened in 1896, Dow Industrial Average by Charles Dow. It was there to track the industrial era because we were an industrial civilization back then. It was shipping and transport and rail, and that was a great way. Those companies were doing well. So then the U.S. economy was so huge. They decided to list the S&P, Standard & Poor 500 large cap companies or medium cap companies. I'm just blanking now. And so what happened was you've got your companies, you know them, Nike, Starbucks, McDonald's, KFC, all these companies, okay? And there's so many of them all around the world. They're all around the world. So that's amazing. And then you get the next 2,000 small cap companies. This is Russell 2000, and they're also all over the world. So when you put all of them together, first of all, you get, believe it or not, these tentacles which go around the world from the biggest economy in the world. And so it's a great thermometer or wind vane or weather vane of how the global economy is doing. I'm going to come back to the cryptos, but this is the basis for it. We need to know this. And so I want you to understand that the NASDAQ was then, because we've become a technological society, they said, you know what, let's make a dedicated exchange, which is the 100 biggest tech stocks, and put them into their own. So they took them from the Dow and the S&P and put them into the NASDAQ. So that's why if they're in the NASDAQ, they also exist in the S&P or the Dow. I want you to understand the logic behind that. So tech stocks have taken a relatively big hit. Look at a few of the others. Look at, to compare this. This is important because, again, this is so awesome because you think it's not connected. This is my fear when people are loving cryptos, and they love it because it's exciting and it's volatile and the value can go up or down and it should go up. What they're also forgetting and what they don't know and what no one's telling them is that cryptos are tied to other instruments. Even Elon Musk, who bought Twitter, chucked a bit of cryptos into that, and he influences cryptos as well, and he's tying cryptos into buying Tesla vehicles. So what's happening is that, and especially in some countries around the world, cryptos are becoming integrated into the economies. So when the economies go, it impacts cryptos. It's like, I want you to understand that where it might have been a standalone thing in the past, which is back here, it's not anymore. These big moves here is when the big institutions started to say to their clients, I'm going to give you some of these new things we call cryptos. I'm going to put them into your portfolio. And this really old person who's like 60, who's got their stock portfolio for the last 50 years or whatever, has been, or let's say 40 years or whatever, has been going, okay, well, I don't really know anything about it, but if you want to sell me something, that's fine. So check these out. So I'm just going to show you a few here. I want to show you a few like PayPal, Netflix. I could actually do it this way. I'll just go like this way. PayPal, Netflix, NVIDIA. Let's go with NVIDIA. Oh, a big one. Autodesk. There we go. Do a few of these. Let me show you Walmart so you can see that. Oh, that's interesting. Disney, we'll chuck in. There we go. Walmart, Disney, Microsoft. AMD, Apple, PayPal, Netflix, Meta. Okay, that's enough. So if we go and bring them across here, PayPal, and let this increase. Twitter, I mean, obviously Twitter's kind of done now. So look at the similarity, if you don't mind. Look at the similarity between this portion of PayPal and this portion over here. Look at the similarity of the structure here. That's because this period and this period, they've been equally exposed or as exposed. Okay, people are putting into it. So let's go look at Netflix. Look at the similarity here, taking the hit. PayPal, Netflix, what did I say? Meta. Okay, so the reason I tell you this is because if tech stocks like these start to recover, it's fair to assume cryptos will recover as well. That's where I'm going with this. We're halfway through, and I've created the basis here for the analysis as we go forward. People need to understand that cryptos are not isolated. They are very much now integrated with other asset classes. And this is not unique. Imagine that we didn't know anything about cryptos. People have been talking about how gold is a hedge against inflation, and you can see money moving from commodities, moving it through to stocks, and then maybe from stocks to bonds, because when you go back 70 years ago, Warren Buffett, when he was kind of getting started, there were only really two things you could invest in. There was stocks and bonds, and you had a 70-30 ratio. So if you don't know this comes from value investing. It's a book that Benjamin Graham wrote. Anyway, his university lecturer who ultimately created the foundation for his investing. And he would say, look, when it's a bear market, you want to be more like 60 to 70% bonds in your portfolio and 30 to 40% stocks. And then when it's a bull market, you want to slowly exit your bonds and start accumulating stocks. And that was the idea. But the world has become way more complex now, and there's more instruments. It's good and it's bad. So cryptos are one of those. So just understand as well is that there are other things out there. If you had 10 grand and you put 2 in cryptos and 5 in stocks, 2 in bonds, whatever, you believe it or not, you would in theory be getting some minimal, very stable growth, some potentially really good growth, some high risk, higher growth, but less stress. Okay, so just remember that sometimes the old-fashioned things work very well. Stocks can do really well. So I wanted to show you this. I wanted to get us to that place. Okay, now let's go and have a look at cryptos in isolation. So one of the things that I wasn't expecting, okay, because I've been relatively bullish on equities lately. I have a YouTube channel and I do a weekly analysis, and so I called the last bottom, meaning I'll show you now just so you can see it. I called this as the bottom, and I still think it is the bottom. So that, and I'm still pretty happy with that for the most part. The one that's lagging, but today did really well, was tech stocks. Tech stocks, I think, are potentially bottoming now. Now, there are criteria, and again, I'm repeating this for the benefit of anyone who hasn't heard me say it. Let me just look at the questions quickly. What do you think about the impact of the FTX turmoil to cryptos and the financial markets in general? We don't know yet. That's such a great question. So first of all, we don't know yet if there's contagion, meaning we don't know yet how much if cryptos had to just completely crash, how much that could impact other markets. But in theory, it's possible, and in theory, it could do some damage. In fact, that's the thing, we don't even know. Because I said to you, it's more complicated these days. We have what's called more derivatives. We have things that are derived to other, or attached to other things that are attached to other things that are attached to other things. And if they fall, you can have this contagion that spreads between them. So that's a great question. On the whole, I think we might be okay. But they were worried, by the way, with that for the S&P. They had just the same kind of concerns. They said, if the S&P is weighted a certain amount or something like this, and these companies make up enough and anything goes wrong with those, it could kind of spread to everything else. It doesn't just necessarily physically spread, it spreads by fear. And then people panic because they don't really know what's going on, they just panic. And then the question was, did I have a mentor? So I've had a couple, and the funniest thing is I've had to get them myself. I had to go get them. They weren't just readily available. But so yeah, I had to go and kind of find them. But if you guys want, I'll give you a couple of really good books that I think will make all the difference. It depends. You can do them as audiobooks. You don't have to read them, but some audiobooks that are phenomenal. Okay, so this is the thing. So this is the rule. If now we're going to talk about the bull market, because basically this is what I want you to do. I want you to keep an eye on the global indices, because if the global indices start to go really bullish, cryptos should follow through. So I want you to know what to look for in the global indices to know we're going back to a bull market, so that you know. Okay, so here's my red 50-period moving average. We are looking at tech stocks. I'm going to use tech stocks because tech stocks right now have had the biggest fall. They're closer to cryptos in terms of how much they've had a correction. Oh, and by the way, just to clarify a few things here, we're always going to have a market correction. It's going to happen when it happens, and it's always going to happen. One of the triggers will often be inflation. So everybody starts making money, everyone's getting a better salary, jobs are doing really well. Then all of a sudden people start spending, but then there's a supply chain issue. So then inflation prices plus demand start to crunch. Then the bank hits the brakes, they put on higher interest rates, and then the market triggers. It usually triggers a sell-off. That's not just the only reason. Most people don't know this, but big institutions often borrow money. So when you get stimulus, you get QE stimulus or just any kind of stimulus cash post-COVID, big institutions can borrow 100 million or 200 million or 500 million at either zero interest rates. Sometimes they don't even have to pay it back. Where do you think they put it? They don't put it into growing their companies. They don't put it into paying their staff. They lay off staff. They put it into the stock market. They accumulate wealth that way. It's relatively low interest rates or interest free. So then they start, so everybody's doing it. So all the big companies in the US are starting to put their money in. So then the market starts to grow. Then when the interest rates go up, all of a sudden the deal's not so good for them because they borrow this money. So usually what they do is they start taking profit. But then they realize that everybody else is thinking the same thing. So then they start taking profit faster. And so you get a bit of a correction there. So I just kind of wanted to add in where the money flows in and out. It's not a conspiracy theory. Actually, a lot of it is really simple mechanics. If you're a big company, you think differently, you do different things versus if you're a little one-man band. But some of these things are available, nobody ever thinks about them. So in other words, some people, as soon as there's stimulus opportunities or any kind of loans that you can get that the government is offering to stimulate the economy, they go for it. And most of them, if they can, will put it into something that will be an investing. They won't put it into the business that it's originally like designed for. They'll put it, especially in the US, they'll put it into stocks. And so they thrive on that kind of thing. Anyway, so, and it will happen. It doesn't really have to do with who's in the administration. This correction was going to happen. In fact, we've had the longest move without one. We've had almost 15 years. It's usually about every 8 to 12 years. It was going to happen eventually, and it's a good thing because the markets have a nice correction. They lose some weight, and then they can pick up again. So it was going to happen regardless. So it's very easy for one party to blame the other party for it, but we should, if we follow through previous things, we should be out of this within 6 to 8 months if it follows the same previous kind of things. And yeah, anyway, so here's where we go with this. We are in a bull market when we are above this 50-period moving average, but not just that. We want to have a really, really stable cyclical move. And these little corrections that take about a month, or they're just normal retracements. We had a change in trend here. We moved underneath the 50-period moving average. So as long as we're under the 50-period moving average, in theory, we're in a bear market. But what I'm looking to see is I want to see us get above that 50-period moving average. So the good news is that gives you enough time, and we have to go far enough up that by the time we get over it, it's not an accident. It's not like a false signal. It takes time, like it could take 1 month or 3 months. It takes time and effort, and the market really has to climb to break that, which is in itself an achievement. It's not just that, but a downtrend is made up of lower highs, lower lows. Okay, an uptrend is made up of high lows, high highs. So a couple of things have to happen. We have to break a previous high. So when we break that, that is one thing on our checklist that has to be done. The next thing we have to do is produce a higher low. So we need to go from a low to a high to a higher low to a high high. In other words, we have to do this, lightning bolt. We have to do that. So we have to break that high. We have to form a high low, high high, and we have to get above the 50-period moving average. So here we go. We've got a bounce, a higher low. If we do this, we break that. That actually goes into an uptrend. And I would say definitely if we break that, there's no doubt we're going back up into a bull trend. But at this point, we would be going up to an uptrend. We produce high lows, highs. Once we go above the 50-period moving average, especially if you see it in the Dow and the S&P and maybe the FTSE and maybe the DAX, then we're back. We should be back into a bull market. And that's on the weekly chart. So all that stuff has to happen on the weekly chart. And what we should be seeing while that is happening, even if it's a lag, is cryptos. Okay, we should see that start to move. Okay, so let's go back to the cryptos and have a look at that. Is everyone with me so far? Does this make sense? Is this useful to you? Okay, so now we're back to cryptos. So one of the things that I was surprised by, and you couldn't really have predicted this, is technically we looked really good. We were actually within a nice little box in this area. We were in a nice little box like this where we should have broken to the upside. And this event that happened was unknown. So unknown events do not actually happen as often as people think. COVID was a big surprise, which is why the market had a big correction to it. Generally speaking, if the market, if we have inflation and the market can see we have inflation and the Fed starts talking about, or central banks start talking about raising interest rates, we can see it coming. And so the market has a correction, but it's a lot more controlled than you think it is. Whereas COVID was immediate. It was really like a panic attack. So this, and you can't foresee that. Not a black swan, because a black swan would be something catastrophic, but it has to be big. This is not big, but what we did do was we broke below that low. And that was something that in my weekly analysis, I was like, listen, equities look strong, and therefore crypto should climb up with them. And then this thing happened and it broke down. In principle, though, I'm still of the opinion, I haven't changed my opinion yet, if the equities continue to climb, I expect us to reverse this position. There might be a lag, maybe a month behind, but actually I expect us to reverse this position and start climbing. But because I don't know yet what the contagion is as a result of this, that's really what has to be sorted. I think once I can imagine right now, everybody within those group chats and on the news and everything are trying to find out what the damage is. I think once it's resolved, we're going to see this recover relatively quickly. And so I just wanted to highlight that. So for me, from an investor's perspective, I see this as a buying opportunity, whether that means putting 100 pounds in or 50 pounds. Like, just do it if that's the case, and understanding that I could wait a long time for that to come back. So actually, it's no skin off my nose, but if it does end up growing, it's great. From a trading perspective, so trading is different, guys. So trading is when you see on any given day, you see a potential opportunity. So just for the day, you're buying or selling. So here you would be selling, because it's going down. So please understand that if you are both an investor and a trader, it's a problem if your trading account, has both your longer term investments and your shorter term trades in. Because your own brain made both those decisions. And so your own brain starts to conflict, it starts spazzing out. And so what you want to do is you generally want a separate account. So if you want stuff in there that you're only going to check once a week or something like that, you put it in a separate account so it isn't there doing this at you the whole time. And your thinking will be clearer and more objective and less emotional, because it's very hard to sell something that you are invested in and buying and hoping it's going to go up in a different trade account. You are emotionally conflicted. So trading is usually about, okay, what's my opportunity today? And you actually have to push out, and it takes practice. You have to push out, yeah, but I want this to go up. You're like, well, I'm gonna have to sell it to go down. And if you can reach that perfect, this is important what I'm about to say, the ultimate goal of a trader who also has an investment portfolio is to get to the Zen point where even if the market for the investment portfolio is going the wrong way, they're okay because they're making money on the market going the wrong way. They're shorting it, or they're hedging it, or they're doing other stuff. So they're still making money. So it's important to understand the difference, because you have to put on a different hat when you do the two things. Okay, so we produced a higher low, higher high here. Okay, there we go. Higher low, higher high. It doesn't guarantee it's going to go up, but it could be a possibility. We could find that we're going to start to go up from here. So potential trade idea, and I'm going to put a trade on. Potential trade idea would be a nice little bullish candle here. The thing is, if you really want to be safe, you actually want to see something like this. You want to take this as your position instead of this one, which means I would actually wait for this to go up, then come down, and then take another trade. So in other words, the market would go further to convince me that it's ready to be bullish. But I'm going to do this as an exercise. I've got a nice little bullish candle here. I've got a nice little uptrend. This is not a super strong setup. On a grading of 1 to 10, this would be about a 5 out of 10 of a grading setup, but I want to demonstrate the idea. So I can place a trade there, and the expectation is if equities are going to climb, then this is potentially going to climb from here. And as a trade, I'm going to do a 3 to 1. So again, investing, you don't want to take the money. You want it to just keep going and going. If it's a 10 to 1 or 20 to 1, you're happy. As a trader, 3 to 1, man, take your money, get out. People go broke because they think, oh, well, it's a 3 to 1 trade, but I've listened to Goldman Sachs said this, so I'm going to hold on to it. And then they lose their money. Don't do it. If it's a trade, it's a short-term, immediate. This is something that's going to happen today or tomorrow, and then it's out. Okay, it's like you're fishing. So now you're sitting here and the fish are in the water. You're watching them go by, and you're like, well, I'm just going to wait till I get the fish out. Like, you don't do that. You've got to feed your family every day. So you catch a fish, take it home, come back the next day, catch another fish, and so on. So you need to, your headspace has to be different. So, by the way, position size calculator is the tool I'm going to use for this. It is actually it's an EA now. It's come through as an expert advisor. So I'm going to show you something here. Stop loss should always be red. I don't understand why they don't do that. Your goal, your targets can be what's called dark orange. I know this. You don't need to know this. My stop price label color, don't know what that is. Entry line color should always be green. No idea why it wouldn't be that. My stop loss should always be red, as I said. And my target is always going to be that dark orange. Okay, so then I'm going to do split orders. I'm going to do 2 orders. Don't worry, you don't need to know this. I understand. I'm going to do 2 orders. I'm going to do a 1-to-1 order and a 3-to-1 order. And I want to make sure that I can see. My dog is busy barking like crazy in the lounge. I should just go smack her because they were here. Now they've left. Okay, so take this one, take profit, and this one. Okay, there we go. Boom. So here's where I am. I can see the lines on the chart. I'm not going to get in now live. I'm going to create a pending order. I want to go long. So I'm going to take my entry, move it above the high of this candle. That's my entry candle. So you'll notice it comes back, produces a green candle, and goes. Comes back, producing a green candle. I want the market to go above that level. I'm going to move my stop loss down to here. So that's my entry. Entry there, stop loss there. And I'm going to target a 3 to 1. Okay. So this is not a great trade setup. It's a 5 out of 10, meaning it is in an uptrend. The general idea is there, but we're about to go to bed. It would be better if we were doing this at 9 in the morning, because usually there's the markets tend to go into a bit of a coma during the Asia session. So I want to go long. I'm going to risk 1% on this of the account. And my take, oh, hold on. There's a 3 to 1. You can set a target here. Initial risk tolerance, no. Here, take profit multiplier, 3 to 1. So I've set it as a 3 to 1. You'll see it changes now, so you'll see this. So now, if I do this, boom, it places a 3 to 1 target there already. And then this is my 1 to 1 target, which I'm going to match. So you see here it says 4747. I'm just going to do this quickly. 4747, boom. So here we go. There's my entry. Not very dark greeny. There's my stop loss. There's my 1 to 1 target here, which is actually near where these highs are. It's not bad. I'm just going to move it a nudge under. And there's my 3 to 1 target. So now I'm going to run the script, which is going to split the orders. So let's go to the terminal. And I'm going to chuck it in. Interesting. I'm going to just run it. So let's just run the script, which now should have created some orders here. What gain share? What's going on? Profit. Deposit, withdrawal, balance 9960. Should be something on. Okay. Up. Okay, there we go. Let's try it again. No, man. Have I just killed myself there? Oh, I'm sorry, guys. Bear with me. This is really cool. There we go. Let's do it again. I really ruined it. Doesn't matter. I'm just going to fix a few of these things very quickly. Take profit 2, take profits with a 3 to 1, making sure that that is true. That's true. The colors, I want it to be just be red. Take profits, dark orange. Entry, strong green, nice strong green. Orange. Take stop loss, red, orange. Okay, I cocked up. I used the wrong one there. There we go. So I'm going to go pending. Oh, it's getting bullish. It's getting bullish. Okay, stop loss there. Okay, entry there. Take profit is there, and then I'm just going to 48.912, 48.912. Put that in. And now I'm going to run this script, which is what I was supposed to do. And that should split it. Boom. So there we go. I've got my 2 orders. It's refreshed now. It's fine. It's actually giving me multiple orders. That's not right. Let's just try it again. Yep. And then I'll move on and carry on with the analysis. Hopefully you guys are okay with this. Okay. And let's try it again. Script. There we go. That's it. 2 orders placed. So I'm targeting 1 to 1. One of them is 0.5% and goes 1 to 1. The other is 3 to 1. It's a bit hard to see them. I apologize. So let's carry on. Let's do some analysis now. So let's go and have a look at the other markets. And what I'm going to do here is start to have a look at Ethereum. So let's take Ethereum. Let's clean up these objects. So let's just clean up everything. And I've got these auto level tools. All of these, by the way, are free. Just look up position size calculator. Just Google that if you want it. Earnforex.com. You'll find it's great. It's free. And there's a cleanup all drawing objects, which was a bit tricky to find. And then fractal support resistance. Fractal support resistance is the tool I'm using. So when we look at it from a monthly perspective, we are in a downtrend. This is really what it's about. We are in a downtrend. This is a big high. Once we break above that high, we're going to become very, very bullish. And we are still in a downtrend, but we are sitting between this high and this low. So usually what would happen is we would actually expect price to continue down to these levels. But I also would like you to see, please, as the 50 period comes along, it's trying to find some support on that. If we go to the weekly, we're also still in a downtrend. We're producing a high and a low, lower high, lower low, lower high, lower low. So monthly downtrend, weekly downtrend. And finally, we go to the daily. And please remember, if you're not aware of this, it's the higher time frames that dictate where the market's going to go. So you need to know what's going on with at least for the weekly, if not else in the daily. Now you can see there's a nice strong surge pushing back, getting us back up above this level. It's very choppy here. It's when the market knows where it wants to go, it starts trending beautifully. When it doesn't know where it wants to go, it's all over the place. So it's important as well that inflation appears to be calming down a little bit in the US. If I go here to the DAX, you can see we've had a massive surge today. Really, really good day today. If I look at, let's look at Apple as an example. So Apple, also big update today. I'm just showing you across the world. Here's the dollar index. Big down day. The dollar hectically weakened a lot. Not hectic. It's a very dramatic term. Gold had a beautiful day today. It's surging. Silver is surging. They're doing really well. This is dollar driven. Okay, so that's good. A weaker dollar is good for cryptos as well. So I wanted to explain to you why you're seeing an update today. And again, people who are in that echo chamber, they're like, well, the reason cryptos are climbing today is blah, blah, blah. I'm like, no, it's because you've got a weaker dollar. Right? Yes, there might be people who are like, it's a good time to buy, but 90% of that momentum is coming from a weaker dollar. So it's really important that in order, even if you only care about cryptos, it's important that you keep an eye what's going on with the dollar and currencies, because sometimes the dollar is the single biggest driving factor. And in fact, all of you, including Leon, who's joined tonight, you've been with me over the last year, you know what I'm talking about. Sometimes the dollar is the only thing moving the market, but it isn't always the case. And I think when all this stuff calms down, the dollar is just going to go back into a coma, and then everything will have its own thing. You'll see euro going up, gold going down. I think gold is going to keep going up, but they'll do their own thing. Whereas when the dollar is like, when there's a bit of panic in the world and a bit of potential World War III with Russia and all this other stuff, then the dollar just steps to the foreground and takes control. And if you're not aware of this, like after 1945, at the end of World War II, the US possessed 95% of the world's wealth. Just in case you kind of weren't aware of why the dollar is such a big thing. It's not as big anymore. It is still the biggest thing. I mean, we don't really deal too much with China, and their GDP is as big. For most of our world, it's funny because we get everything we buy kind of comes from China. But in terms of how much money I don't interact, I never pay things. I'm buying stuff from the US that's made in China. But point is that US economy is still very strong. Look at the FTSE here as well. Also, big surge to the upside. So when we look at some of these, we've got as Bitcoin Cash, US Binance. Binance, really big day today, nice little boost. So I had a heavy day yesterday, pushing back up. So what we want from a trading perspective, there's shorter term trading opportunities. You want a really nice move like this. This is great. Like really nice moves, trading, and it's a short term move. There's a nice little candle there, put entry above, stop loss, target 3 to 1, take your cash, finish for the day, go to bed. It's not the same as investing. It's really like, that's crucial. Once you get that, like a whole lot of things will change, because you're like, okay, am I trading now or investing? And it changes the game. It means that when you're having dinner with friends and you're talking about this stuff, you can say, well, yeah, shorter term, I think cryptos are going to go up, but I think they're overextended. Those are, so my conversations around the dinner table or when chatting to people are very different, and they're almost more trade based than investing based. I'll almost be like, this is my shorter term expectation, meaning shorter term is days, medium term is weeks, longer term is maybe a couple of months, nothing more than that. Okay, guys, we have some time. Okay, audiobooks. So put all your questions in there, please. Put all your questions in there, please. And this looks good. I'm happy with that. Let's see how it is. So the next webinar, which I'll do, I'm away. I'm actually in New York, in Wall Street. I'm staying in Wall Street from the 22nd to the 28th. So I'm actually in New York for a while, which means I won't be doing any webinars during that week, but I usually am doing 2 a week. And in principle, shorter term, although I can see we've got a bit of a mess we have to work our way out of, over the next few days or weeks, I expect us to start heading a little bit higher. And most of these look good. And the one that's, you can pick the one you like the most and follow that. But like Ethereum, this is a no-brainer. Check this one out. So I'm going to do it again. I'll take another one on this one. So position size calculator. I'm going to cheat a little bit now because I'm going to go back to the other charts and I'm going to steal the settings from it. So I'm going to go here. I'm going to save the settings and I'm just going to call this one PSC. And today is the 10th of November 2022. And then I'm going to go to the other window and I'm going to pick up those settings and hopefully they do load up correctly. Boom. Then I can go here and I'm going to go instant because we've already broken the high, but I'm going to move the stop loss down, risking the 1%, take profit at 3 to 1, put in 5572, and I'm going to, that's it. We'll run it, run the script, and we're in live. Cool. And then we'll see how we go on that. I think I'm going to bring it just under here. This one, just below these levels here. So it's a little bit less than 1-to-1, but we got that one. So write your questions while I give you some of the books that I want you to do well in. So there's a couple here. So the best one that will give you, it's called Naked Forex. I'm going to show you the book now. It's phenomenal. So that's this one here. Naked Forex, which is really good. Is it value investing? Benjamin Graham. This is more, some of these are like, this shouldn't be an audiobook. Naked Forex has got visual pictures, you need that. This is called The Intelligent Investor. This one is a great book. Phenomenal. It's old-fashioned, but it gives you the right ideas. You need to have the right ideas. What is going on here? Intelligent Investor. Thank you. So this is Naked Forex by Pete something. Then we've got this one here, Intelligent Investor. Then if you haven't read any of these, you have to. Larry Williams on price action is pretty good. No, let's forget about that. Let's do Market Wizards. So this is a series of books that are just, all of them are great. And they're all, there's no pictures. So all of those can be audiobooks. They're great. Listen to them if you want. They're interviews over the last 30, 40 years. Every 10 years produces a book where he interviews traders of all capabilities. Individual retail traders like you and me, institutional traders all over the place. It's phenomenal. It's very good. Then we have I'm trying to think. Naked Forex is phenomenal for technical expertise. It's great, and you can pack it all across to here. There's nothing about it that you can't use in cryptos for technical skills. I feel like I'm leaving out. Oh, this one. Please read this one, because you think all the things you're going through and all the emotions you feel and all that stuff, you think it's all unique to you. Almost all the things you go through are what we call universal experiences, called trading in the zone. Mark Douglas. It's easy read. You can actually do that as well as an audiobook, and suddenly he'll talk about stuff that you're like, that's what I know, that's how I feel. And so you need that book to tell you that the things you're going through are normal, and how you need to work that way. That's a good one. He does another one called The Disciplined Trader. These books will change your life. This one, there's two books that are not trading related, but will improve your trading. This one is called, the last two books, and I will give anyone who wants a link to this recording, you email me and I'll send you a copy of the link of the recording. This one is called The Organized Mind. It's definitely as an audiobook. It's a hard read. If you love to read, get the book. But to me, I've been listening to this as an audiobook for 4 weeks. It's like there's so much in it, but it explains how we've gone from being cavemen to where we are now, how brain thinks. And it will teach you about the way your brain thinks and deals with stuff, which will explain things to you about why you do certain things and how to change your behaviors because of your brain doing it. Phenomenal. So there's that one. And then finally, and this one is, to me, is also mind-blowing, is called Thinking in Bets. And this definitely impacts your trading. Annie Duke. I say Annie Potts, it's Annie Duke. This one is phenomenal, and it definitely impacts your trading. She's a professional poker player, and she talks about how bad we misread probabilities and statistics. We don't really get that. And the Disorganized book talks about that as well. We really don't know what we're doing with that stuff. We're very bad at it. There are times when we make decisions completely the wrong way around because we're not thinking correctly. Cool. So those are the best ones that I can think of. These will change your life. Think Your Bets will change your life. Organized Mind will change your life. Disciplined Trader will change your life, and Trading in the Zone will change your life. Most of them, if not your whole life, at least some of your trading. And then these are specifically investing. That will change the way you think about investing. And trading, this will be the best one. That's like, to me, is just the best go-to book. Everybody should have that as a go-to. They should get that in one hand and the Trading in the Zone in the other. Those are the two books, those are your two big ones. So any questions while we wrap up here? In principle, these are starting to look bullish. I think from a trading perspective, I wouldn't actually trade them right now. Although I've taken a trade, I'm doing it based on today's big moves in the market. But right now, cryptos are not really beautiful. They're very choppy and messy. So when we look at a few of them, they're just a little bit there's a little bit of a mess going on with some of these things. And I therefore don't see them as being really great tradable opportunities. When you want to trade something, you want to trade something, if you really are serious about trading, then what you trade must be smooth and really easy and very high probabilities. And if today that's crypto is great, if today it's not cryptos, they're choppy and messy and all over the place, and maybe gold is trending beautifully, then you would trade gold today. So traders don't care what they're trading. What they do care about is the probability, the pattern setting up and the high probability of it, because they're just catching a fish. They just got to do that. Whereas investing is more like you want to grow your own fish pond kind of thing. It's a different headspace. So any questions, ladies and gentlemen? These, I'm afraid, you're going to have to find those audiobooks on your own. I just buy them. If something's a PDF, I'll Google it and I'll find it. And like Trading in the Zone, you can find as a PDF somewhere. So you can do that. But with where to listen to them as audiobooks, I'm afraid you're going to have to find out on your own. I don't know. I just don't know. I just buy them on my thing. So there was just such a great question, Uber, about the FTX and the financial markets. If you want to send, first of all, just so you know it exists, I've got a YouTube channel with where more of this stuff is if you have any other questions. But that's really just to help you, just going to the channel here, just to help you find more stuff if you want. So just Google this. But I was going to say to you, if you have any questions and you want me to send you a copy of the recording, please just email at adam@tradewithprecision. This is adam@tradewithprecision.com. So tradewithprecision.com, and then with the title like webinar recording, please. And then I'll just reply to it with the link to the recording. Okay. Ladies and gents, are there any other questions? I hope you found this instructive and useful. Believe it or not, that it might not seem like we spent a whole lot of time on it, but you've got a lot. It's a bit of a wax on, wax off session where I'm doing one thing, but you're actually learning something that's relevant to what we're doing here. In principle, we're not in dire straits with most of these things. We're in a really weird place at the moment. We're on a downtrend. We should start to recover, especially if equities are starting to recover. There might be a bit of a lag. From an investing perspective, these are really cheap. From a trading perspective, if it's still downtrending, you're selling, and then when it starts moving up, you start looking for buys. This is very premature. What I did here is literally the first uptrend we've had in, we had an uptrend here the other day, but and also explain to you guys the difference between trading and investing. Thanks, Leon. Always a pleasure. I will let you guys go. Unless there's any more questions, but thank you. Yeah, just send me an email and I'll send that stuff through to you. Okay. Thank you, ladies and gents. If you do, let's go back to the final page as well. If you have any other questions about your account or the platform, you need any help with that, don't hesitate to get in touch with the lovely folks at IC Markets. Support at IC Markets, and of course available on social media. Yeah, and I will, and then I'll help you in any way I can. All right, I'm going to let you go. Thank you very much, ladies and gents. Thanks, Godwin. Appreciate it. Bye, guys.